Hey everybody, this is Bob from Trade Genius. Got my good friend Phil here. You ever hear of the Moody Blues? Well, we're going to have Moody money. Stay tuned.
Trade Genius.
Okay, Phil, you dug up some charts. I dug up some charts for you on interest rates, and not so much the levels that are important, but it's really the volatility of the interest rates that's going to cause this great pain. It's also predictive of economic recessions. Can I throw it over to you and explain that to the folk?
Yeah, right. So basically, what we're looking at now is the move levels are elevated, very elevated. And what move is basically a measure of the volatility in the bond market. And that's very important because the bond market is extremely large. And that's usually where the moves in the bond market are usually the ones you want to pay attention to because that's where the big money is. So if you look at this chart that we got up here, basically on the bottom, it's showing you the different levels of the move contract. So there's 50, 100, 150. And what these bars are telling you that is that as the move reading go higher or the prints on the move go higher, the returns on the stock market drop and they go negative. On Friday, we closed at a move reading of 128. So move is similar to the VIX, but just for the bond market. So at between 100 and 150, you go into negative returns. So we're in a negative return environment here. It's going to be very hard for this market to go up if the move is over 100, which is our current situation. So that's what this is showing us. The other thing that's very important to point out is the divergence between the move contract and the VIX contract. So if you'll notice here, we've highlighted that move in orange is quite elevated over the VIX. Okay, so move is the bond volatility, VIX is the S&P 500 volatility. Last time we were this divergent was just before the great financial crisis in 2008, just before that big crash, and we had that big move down into the first part of 2009. So there's a lot of warnings going on right now here. A lot of people, I noticed, Bob, are looking at the October seasonality and thinking that since we've been tracking seasonality so much, that we're going to start going back up. The problem with that, though, I might point out, is that we're going into a heavy long duration bond issuance. And that's not something the seasonality takes into account of. It's just really a mean of what the moves are typically. It throws out the top performers, it throws out the lowest performers, which means that you could have an off year and not track that at all. So it's kind of like a loose guidepost, but at any given time, you can deviate from seasonality. Now, if things line up, if there isn't heavy bond issuance, then yeah, the probabilities of going up in October are much better. But I think you have to look at what's really driving this market. And the bond issuance is going to be a repeat, I believe, of what we saw in the first half of 2022. So that's kind of a big issue. And then you also had brought this chart over, and I'll let you speak to that too. But higher rates means higher volatility. And if you look at where we are with rates and with volatility, you'll see that we're basically up there in that .com era. And that certainly was a lot of pain for a good 12 months. What say you?
Yeah, I agree. And what happens is when you get interest rate volatility, it'll lift the VIX. When you lift the VIX, it means that risk managers have to pull in their horns on taking risk with equities.
Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
And I think it's going to push even more money onto the sidelines in bills or into the treasury bond market, longer duration bonds, which are going to just suck more money out of the stock market while we're going into recession. And where this war activity is it's a crossroads of the world, right? So energy crossroad, food goes through there. A lot of big countries are at risk. So, it just takes one match to blow that thing up, and we're never land. And so my perspective, Phil, well, you and I we've been macro bearish here for quite some time. We're finally starting to see the stock market reflect that. And I agree with you. I think a lot of people are going to try to buy the dip here without realizing what's really been driving the stock market. And I think that those guys are going to get burned. I think Thursday and Friday were very interesting. Thursday I was traveling and I missed that bond auction dump. And on Friday, we shot up again. And then as soon as it got to about halfway to the close of the European markets, is that they just dumped it all the way through. And I think, Friday you usually get followed through to Monday. So my expectation is that the next bond auction's Wednesday, I believe, is that the market's going to be soft. And then if that fails again, a lot of people are putting protection on. I think people are ready to strap in now, Phil. So it's going to be a wild ride. Look, in 2008, it was very unpleasant to trade, by the way. You remember that. one day up, one day down, one day up, one day down, people couldn't keep up with it. So
Right.
might be better off if you're not a really good trader, short term, you might want to just take some chips off the table and let this thing ride out for up to probably 4 to 6 weeks here.
Yeah, and if you just simply look at the weekly 9 EMA, no good things happen under the weekly 9 EMA until you get really far under it and stretched under it, and then you might get some reliefs. And so currently right now we're falling back under it. I think this is now the third weekly close under it. That's not a bull market thing. So you need to really pay attention to what's going on here. And it definitely, just based on that alone, would be risk off. Yeah, so to your point, there's a 20-year bond on Wednesday, October 18th. So because these bond auctions now have introduced their own volatility, you have to be very cognizant of when those are going to happen. So that's going to be 10 a.m. Eastern, October 18th. So that's going to be the next big one. So just keep an eye on that next week. For that, that may also introduce another volley of volatility. If you got any open positions, you might want to just be careful around that event. So other than that, Bob, I think that was it.
Yeah, that's all we have. Maybe we'll talk Monday a little bit. Where the safe havens are starting to form here. So we'll show you some interesting charts then. If not, hey, I'm dark in here because we're filming this during the eclipse and we're in a 90% zone. So I hope you guys enjoyed that if you could. And if not, enjoy the rest of your weekend.
See you guys later.